There is no certain way of choosing stocks that will go up in price. However, two stock ratios that people commonly look at before buying shares of a company are the current yield and the price earning ratios. Let's look at the current yield. It allows us to compare stocks that sell at different prices. It is expressed as a percent, and sometimes it's in a table, but we're going to take a look at the formula so that if it isn't present, that we can calculate it. To find current yield, you divide the annual dividends per share divided by the closing price per share. And let's look at an example. We have two companies here, Best Buy with the closing and dividend information from a stock table, and Barnes & Noble, again closing price and a dividend rate given. So to calculate the current yield, we will take the annual dividend per share, and from the table this was a quarterly amount, so we need to take our quarterly times 4 to get us our annual dividend amount per share, and then divide that by the closing price per share. So the yield is a 1.4%, giving us that ratio of dividend to the cost of that stock. How does Barnes & Noble stack up? They're giving a quarterly dividend of 25 cents, but their stock is substantially lower. So what does that do in terms of the current yield? We'll calculate the annual dividend by taking that dividend value from the table, multiplying it by 4 because it's quarterly, dividing it by the closing price to give us a yield or return on investment by buying a shares of 5.4%. So in terms of investment standpoint, Barnes & Noble looks much better because of this ratio of dividend to price per share. It should be noted that not all companies pay dividends. Several reasons. It could be that the company does not have the profit because of some difficulties to pay out to the shareholders. It could be that they're pouring their profit back into the company for growth reasons, and that money is used for research and development, or kind of along those same lines, it may be growing so rapidly and needs that money for expansion as well. The other number that some people use to help decide which stock to buy is the price earning ratio, also called the PE ratio, and it's found by taking the closing price per share, which we get from our stock table, divided by the annual net income per share. Let's calculate a couple figures. Here we have General Motors. The current price per share is $53.01. The net earnings per share is $6.68. And so when we calculate our PE ratio, we will take the current price divided by the annual net income per share. And typically for a PE ratio, it's rounded to the nearest whole number. Let's do another calculation. Here we have General Electric. Current price per share is $46.18. The net earnings is given as $1.27. And here we have a much higher PE ratio expressed as a whole number of 36. One more example and then we'll take a look at what these numbers are telling an investor. We have Nike. Current price per share $49. Net earnings per share $2.19. When you take your closing price per annual net income per share, it ends up with a PE ratio of 22. The higher the PE ratio, the more the market is willing to pay for each dollar of annual earnings. For example, a PE ratio of 20 means an investor is willing to pay $20 for $1 of current earnings. Investors are often willing to pay more for rapidly growing companies because these companies have the potential to generate even higher profits in the near future. They're on their way up. As a result, the PE ratios of rapidly growing companies are often higher than those of slow growing companies. A low PE ratio may indicate that a company is growing slowly and perhaps a more safer investment, but research is needed because sometimes it could be indicative of a company having financial problems. It is best to compare the PE ratios of similar companies. Our examples, we were kind of all across the board, but here, if you're investing in an oil company, look at a similar oil company, or whatever company you're looking at, look at a similar company manufacturing the same goods or in the same type of business to make a comparison. It is noted here that it's usually not worthwhile to compare the PE ratios of very different companies, Walmart and Exxon, for example, because of being such different businesses, it wouldn't make sense to compare their PE ratio.